Many people think that the Bank of Canada can't raise interest rates because there would be a lot of Canadians that wouldn't be able to afford their debts, therefore triggering an economic collapse. But what if the reverse was also true? What if the Bank of Canada had to raise rates sooner than later in order to avoid an economic collapse of a different kind? What's up everyone, Conrad Neufeld here, and today we're talking about the Bank of Canada's key interest rate, the overnight lending rate, which as of the date of this video currently sits at 0.25%. In the last Bank of Canada update, just like the one before it, the Bank of Canada signaled to the markets that they were going to hold this key interest rate steady until sometime in 2023. But something peculiar happened between the last update and the one prior to it. Between the last two updates, the bond market effectively called BS, saying, no, you're going to do it sooner. So let's talk about why the Bank of Canada might be saying one thing when they may or may not be intending to do something entirely different. The Bank of Canada really has four key functions. The first is that they want to help manage the funds for important institutions and the Government of Canada. The second is that they're responsible for supporting the financial system in Canada through the development and implementation of policy, as well as providing central bank services like liquidity to banks, credit unions, and the financial markets. They're also the only ones allowed to legally print money in Canada, so yes, that means you can't print your own. So effectively, they control the supply of the currency. And last, but definitely not least, they're in charge of Canada's monetary policy. Their goal here is to keep inflation low, stable, and predictable at about 1 to 3%, and they do that through a combination of quantitative easing, that's the increase of the money supply, and manipulation of the overnight lending rate. But there's one more thing that the Bank of Canada does that you won't find listed on some website. And that's that to fully be able to do their key functions, they have to also appear that they have control over the markets. Because if they can't demonstrate that they have control, then the markets and every single Canadian might start behaving in a way that would make it very difficult to achieve the stability that they're looking for. So what that really means is that not everything the Bank of Canada says can be held at face value. Instead, what you have to be asking yourself is, what is the Bank of Canada trying to achieve by saying the things that they are saying? What effect are they trying to create? So let's take that one step further. By saying they're going to hold the key interest rate until 2023, what effect are they trying to create? Essentially, they're saying there is no inflation yet, and that things are stable while they stimulate the economy. They're trying to say that they're in control. They're trying to say that we're keeping the interest rate low by choice. But let's peel back the layers on this a bit. What the Bank of Canada is really trying to accomplish is avoiding a wide-scale collapse, just like they've been trying to do in all of 2020. What they really want to avoid is deflation. And honestly, they're right in doing that. We as Canadians do not want a deflationary market that could easily turn a bad economic time into a severe recession, or worse, another depression. But here is where it becomes a little bit tricky for the Bank of Canada, because they have a bit of a balancing act to do here. Canada got hit harder than the US, at least economically speaking, during COVID, which means we as Canadians have a far longer way to go in terms of recovery than the Americans do. On top of that, the Canadian dollar is already trading at about 79 to 80 cents relative to the US dollar, which is already too expensive. We as Canadians want our dollar to be trading at somewhere in the neighborhood of 77 to 78 cents. That tends to be the sweet spot for trade. So the Bank of Canada actually can't raise rates yet. We actually have to wait for the American Feds to raise their rates first. Because if we as Canadians move our rate upwards first, that will put a lot of pressure on the Canadian dollar, making it even more expensive for Americans to buy our goods. And if that ends up becoming the case, then we could see a reduction in our trade and as a result some more recessionary pressures. So the Bank of Canada is signaling to Canadians that it's by choice not raising the interest rate. But they also don't have a choice, because in doing so it would too negatively affect exports. The other thing to consider is that the Canadian government secretly wants inflation. Canada's finances over the last 5 years in large part have been mismanaged, and that's particularly true during this pandemic period. Canada has somehow managed to create the least amount of jobs with the most amount of money spent per capita than every other nation in the G8. It's true, every other country is now sitting on a ton of debt after this pandemic crisis, but Canada took it to a whole other level, and that's where inflation becomes a handy little tool for the Canadian government. Let's say you had two imaginary politicians. The first politician wants to come and tax you an additional 20%. Now, you don't get anything extra for this additional taxation, you just get the comfort of knowing that the country is paying down its debts. How much do you like politician 1? You don't. You think he sucks and you want to hear what the second politician has to say. So politician number 2 comes along though and says, no tax increase, we might even put money in your pocket. But once elected, he or she runs fiscal policies that result in your purchasing power decreasing. So you make the same amount of money, but housing and rent gets more expensive, groceries get more expensive, money starts to get so tight that you don't even know if you can afford to fill up your gas tank. You hated politician number 1 because they were coming to take your money, but politician number 2 effectively made the money that you had worth nothing. And that's why it's such a great tool. The majority of Canadians are still going to vote in the second politician, even though the situation is worse, because most won't be able to connect the dots between the fiscal policies and the inflationary environment that politician created. They'll just blame their situation on a bad minimum wage, or the rich not being taxed enough, or the structure of capitalism as a whole, and not realize that the fiscal policies enacted by that government is how they got there in the first place. Meanwhile, because money is worth so much less now, the government is able to pay down their debts easier than before. Inflation is a great way of devaluing debt. But of course, inflation can't go unchecked, so eventually interest rates have to rise. Now, a lot of people say the Bank of Canada actually can't afford to raise its rates because the housing market is already grossly overpriced, and if interest rates do rise, it could cause a housing collapse. And that's partly true. But if inflation does happen and the Bank of Canada and Feds don't raise rates quick enough, then the investors and the market might start to believe that the Bank of Canada and the Feds are behind managing the inflation problem. And if that happens, you might see a significant impact on the long end of the yield curve, which could mean a very negative impact on the stock market, possibly triggering a recession. So that's where this balancing act for the Bank of Canada comes in. Because you don't want to raise rates too soon or too fast, because if you do that, you could affect exports or have Canadians reduce their spending, both of which would cause a recessionary pressure. But you also don't want to wait too long to raise rates either, because if you do, you could end up in a situation where you lose the confidence of the market, and that could have a negative impact on the stock market, also having a recessionary pressure. What you really want is a slow, gradual climb, and that's why they're going to have to raise rates sooner than 2023. Now, like I said before, the Bank of Canada doesn't want to lose the confidence of Canadians and investors, so I think there's going to be a few things that are going to happen. Number 1, the Bank of Canada may continue with their quantitative easing in some part to reduce some of the shock of the increasing interest rates. Number 2, based on what we're seeing on the yield curve, it looks like the bond market is expecting the Feds to move in the third quarter of 2022, but it may happen sooner. If that happens, and if the Canadian dollar is still too strong relative to the American dollar, priced more at that 77 to 78 cents price range that we talked about before, then you may see the Bank of Canada hold on to their rates just a little longer until that falls and becomes more in check. Number 3, when they do move the rate, it will be a small adjustment at first. There has never been a time in history where Canadians have been more sensitive to interest rates than right now. We're dealing with an entire generation of Canadians that know nothing different than either a stable interest rate or a declining rate environment. Some analysts even go so far to say that our sensitivity to rates is double what it was a decade ago, and that's up from a decade before that. This means that the Bank of Canada is going to have to do everything in their power to try to avoid significant jumps in rates, because even small adjustments are going to have a big impact. And number 4, the Bank of Canada will package this as a positive thing. They'll say something like, inflation is at or above our intended target, and the economy is demonstrating enough recovery and strength that we feel comfortable raising interest rates earlier than previously planned. The Bank of Canada doesn't just have to worry about the welfare of all of the Canadians out there, they also have to manage inflation expectations. And the words they choose to use are going to have a big part of that. The chief economist of CIBC, Benjamin Tal, even goes so far as to say that the Bank of Canada right now has more to benefit from a PhD in English than a PhD in economics. The raise in the Bank of Canada's interest rate is going to be absolutely necessary. But how it's packaged and how it's presented to Canadians is going to end up being just as important.